His focus is on the next generation, inexpensive global car that'll be done first in Mexico, but also with an assembly line in Austin, Texas, because he likes his designers to sit next to the assembly line. And there are many places he's talking about, including Turkey, as you said, but I wouldn't hold my breath for Saudi Arabia.
Got a pretty stark concern about what's happening with the economy right now. You think we could be in full-fledged recession by the end of this year?
Oh boy, do we have an exciting video for all Tesla stock investors. And now we're going to cover a wide range of topics, including the Cybertruck. We're getting more images from the inside and some of the ambient lighting that, let me tell you right now, is absolutely stunning. We have other Tesla specific news to get into as well. But as we showed in the first couple of seconds of this video, there are some quote unquote experts giving you some pretty dire warnings, as well as some new consumer data that shows 92% of Americans have cut back on discretionary spending within the last 6 months. I would argue a lot of that cutback has been in just the last couple of weeks alone, and not so great things are projected over the next couple of weeks. So we have a couple of quick clips to play for you on that front here in this video. As well as that, we are going to go over some of the sentiment numbers in the markets and explain what I think at least is coming next for Tesla stock as well as the broader markets. So we have a big one for you. We're not going to waste your time. We're going to get into it. But first, if you are an investor in Tesla stock, you like these videos, or you just want to make more money, hit that like button and subscribe to the channel because, well, this is your place to be. We cover everything Tesla every single day as well as the broader markets. And we're going to get into it right now. 3, 2, 1, let's roll. Now, first thing I want to start this video off with is the images we are getting from up close and personal inside the Cybertruck. And what stands out to me is look at the size of the screen. And really, probably the most relevant thing to compare it to is Elon's hand, or maybe the steering wheel. We can all imagine what size that is going to be. And this screen is much larger. Most notably, it's pretty tall, or kind of vertical compared to some of the other screens that you see in Teslas today. And look at this image. This is the Israeli Prime Minister. They do seem to be meeting quite a bit, so we'll see what ultimately comes out of these meetings. But look at this ambient lighting. Absolutely beautiful. And look at Elon's smirk on his face. Definitely a proud father of the Cybertruck. And I think it's safe to say the Israeli Prime Minister is also one happy individual. Look at that cheesy smile there. We are now going to play a couple of clips I put together that I think you really need to hear as an investor in Tesla and in the broader markets. Comment down below, as well as like the video or some way, shape, or form. Just let me know if you like these different clips clipped together in these videos. I think it's a pretty efficient way to get a lot of different opinions and a lot of different information in a short amount of time that maybe you otherwise wouldn't have seen.
Okay, got it. So Turkey could potentially be in the running. I mean, there's also been talk of India as well.
Yes, and I think he's going to India. There are a lot of places. And if he's going to make this inexpensive global car, there'll be millions made, he is going to design a platform, but more importantly, a factory that will make the platform, an assembly line. And it will be highly automated, I would guess. He spends a lot of time. I've seen him spend a lot of time going station by station and what a factory should look like, and what do you automate and what do you not automate. And as you just talked about the United Auto Workers strike and everything else, I think having a lot of options in the future with highly automated factories that can be replicated, I think that's a good strategy.
I guess, so how does that speak to the navigation of Musk, of all the geopolitical cross currents? I mean, Turkey is an ally and a member of NATO. It's an ally of the U.S. It's a member of NATO, but it can be a little bit of a tense relationship in of itself. India, we know, is benefiting strongly from the tensions between the U.S. and China. He's obviously got a big footprint in China with Tesla, too. He does seem to move around and communicate with and negotiate with world leaders in a way that, dare I say, seems, maybe Saudi Arabia excluded, seems a little bit smoother than others sometimes.
Well, definitely. I think a lot of countries, be it India or Turkey, would and have said they would love to have a Tesla plant. And I think that he also has, he controls his whole supply chain. When he first took over, when he first was putting together the group that was Tesla, they were making the batteries in Japan, and the battery packs would then be in Thailand and England. They put them in the chassis. And he wants end-to-end control, just like Steve Jobs did. So he'll be making his own batteries, making his own battery cells. And there'll be a lot of places where I think he's going to want to have investments.
Speaking of world leaders, apparently reports today that Musk says Twitter, now X, is moving to a small monthly subscription, has 550 million users, and this apparently came up in a live stream conversation with Israeli Prime Minister Benjamin Netanyahu. Have you heard anything about this idea of a subscription? I mean, I know you have to pay to be verified, but could we be seeing an overhaul of the economic model there in general?
Absolutely. I don't think he wants it to be advertising dependent. More than 20 years ago, he created X.com, which morphed into PayPal, and he wanted it to be a payments platform, a place where people could post content and even get paid for it. And from the very beginning, even before he took over Twitter, but after he made the offer in April, he said it was an accelerant to create what he wanted to do 20 years earlier, and then got ousted when it was PayPal. So I think that he wants to get away from a pure advertising model. Obviously, there'll be subscriptions, but there'll also be ways to pay for things. You look at WeChat and other things around the world. They're able to do that. And I think his live stream with Benjamin Netanyahu, the Israeli prime minister, was fascinating today. They also talked about anti-Semitism. Netanyahu talked to him about that. And Musk is just quite controversial. The problem is not the ADL for X, the platform that used to be known as Twitter. The problem is advertisers don't want to be in a very contentious, controversial, sometimes toxic place. So I think, A, he's got to tone that down a bit, and B, he's got to find other revenue than advertising.
Is Tesla a big winner broadly from all of this, no matter what deal gets struck?
Well, you look at the comparative wages or all-in costs for labor at a GM, at a Ford, at a Stellantis, and then you look at the $45 number at Tesla versus, say, call it a 70 number that's about to go much higher. And given the automation at the Tesla facilities, the non-union plants have a cost advantage. Now, whether or not the Tesla story plays out from a profitability perspective, that's maybe that's for another segment. But yeah, there at this point in time, there's a definite cost advantage.
We want to bring in Tim Higgins, Wall Street Journal reporter and a CNBC contributor. In his latest column, Tim says that regardless of the strike's outcome, Elon Musk has already won. And Tim, thanks for being here. That may be a little self-descriptionary, easy to understand from all of this. Elon Musk is not dealing with unions in the same way. He doesn't have any unions.
Yeah, he's not at the table, but he's definitely, his presence is kind of looming over. It gets down to the labor costs. The UAW workers at these Detroit automakers, on average, all in is about $66 an hour. That includes benefits. At Tesla, it's estimated at $45 an hour. So from day one, when they start talking about spending more, Elon wins because Tesla is cheaper to make cars over there for those electric vehicles. And it's not just cheaper, it's also they're working to cut costs even more in the future. They've already talked about slashing manufacturing costs by like 50% for the next generation vehicle. So, the UAW would probably say it's a race to the bottom, but it is a race to make electric vehicles profitable, and Tesla is doing that, whereas the likes of Ford are not.
Now let's go ahead and take a listen at some of the multiple warnings we heard about the markets today. And some of this data we're going to go over next, not that great.
Majority of U.S. adults feel the current economic environment is having a negative impact on their finances. That's according to a new exclusive CNBC Morning Consult survey. Middle-income households are feeling the negative effects the most, sentiment that has held steady since our first survey in June. Higher-income households say they're feeling the effects less than 3 months ago. And sentiment among top earners is shifting. 30% now say the economy is having a positive impact on their finances. That's up from 21% in June. Still, almost everyone, 92%, told us they have cut back on spending over the last 6 months. Clothing, restaurants, bars, and entertainment remain the most common categories for cuts. Looking ahead, more than 3/4 of consumers say they will cut spending on non-essentials sometimes or more often over the next 6 months. We will continue to watch this closely as we get into the all-important holiday shopping season. Interesting the way we're getting some splinterization on income brackets.
Also, I thought it was interesting that restaurants were included there because none of it surprises me on goods. We know that's been softer and that's not where consumers are spending after they spent so much on COVID. But services is what has stayed hot and sticky. So deceleration there is notable, I think, for the Fed's inflation fight.
And an accompanying decline in stock prices.
So the recession that you're predicting is probably not going to happen in 2023, but maybe
it may start in 2023.
The Federal Reserve recently said that they think we've cleared the recession hurdle, and they don't really project a recession any longer. Do you disagree with the Fed on that?
Yeah, I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles. They prided themselves in stimulating the bubbles. They took credit for the beneficial effect of higher asset prices on the economy. They have never claimed credit for the deflationary effect of asset prices breaking, and they always do.
Fed's going to be beginning its two-day policy meeting tomorrow. The markets are widely expecting the central bank to keep rates unchanged this month. For more on the Fed and where yields could be headed, we want to bring in Kamal Srikumar, who is, of course, the president of Srikumar Global Strategies. Sri, let's talk a little bit about this because you've got a pretty stark concern about what's happening with the economy right now. You think we could be in full-fledged recession by the end of this year?
That is what I expect, Becky. I think you have a recession which has been delayed by an enormous amount of stimulus coming from the fiscal side and monetary side. But that can delay a recession, but you cannot deny it eventually. And that is what is coming to you. The signal is coming very clearly from the bond market, especially the Treasury yield, the 2 to 10-year yield curve being inverted starting July of last year. So we have been inverted for quite a while. I face the question from clients from time to time, if that has happened and it is 14, 15 months ago, why haven't we seen a recession yet?
Right.
The change that we have this time is we have not had enormous amount of stimulus at the same time as in the past cases of inversion. So that's why I think it is getting delayed. But clearly the signs are that there is an exhaustion in terms of the economy, and that is going to show itself in terms of a recession.
What signs are you pointing to? Because a lot of economic indicators right now are pretty strong. If you look at the jobs market, if you look at across the board places, it looks like we have seen inflation maybe come under quite a bit more control. That's why we think the Fed may be almost done, if not completely done at this point. What do you see besides the 2-year, 10-year and the bond market?
Let's look at other things. One, the manufacturing growth has been down. It's been negative for about 5 or 6 months in a row. The S&P global expectation of the economy has also been down. The consumer sentiment coming from the University of Michigan, the latest number was down, which was also not expected. And so what it suggests to you, Becky, is that the consumer on which we depend for 70% of GDP is finally going to find the end of the rope in terms of spending. And that has taken a while of time because there has been so much in terms of government money in the consumer hands, and that's, I think, going to change. So those are 3 different factors. Then you talked about inflation. Yes, inflation is down, but the core inflation may be down, but the headline inflation is headed up. That's my key thesis. The central bank focuses on the core inflation rate, which excludes fuel, excludes energy, and food. But then in this case, we have domestic price of gasoline starting to rise with the Brent and the WTI crude that Andrew spoke about a few minutes ago, and they're going to continue to go up. And that will be reflected in the price of gasoline and therefore in the headline rate.
So what's the Fed going to do? If they're facing a downturn in the economy, but also facing inflation that's coming back on a headline level at least, will they stand pat? Will they raise rates? Will they have to cut rates as you're looking at a declining economy?
That's a great question. That's the quandary, because the problem is the European Central Bank has one mandate, inflation. The Fed has two mandates, and essentially it's illogical. You can't deal with both of them at the same time. You have to give up on one of your targets. So I think because of the fact that you may have a recession plus inflation staying high, the Fed has to decide what to give up. And in my latest writing, I've been saying that with elections being just over a year away, the Fed simply gives up on the inflation. And how do you give up? You can't say a 3.5% inflation rate is okay for me and we have succeeded. That won't be accepted. It affects credibility. So instead of pausing just in the month of September, you increase in November, let's say, and then December through the first few months of 2024, there's an extended pause. You never raise rates again. So my expectation is there is a pause, and after which the rates will come down. It also depends on when a credit event happens. If something breaks in the system, then you're going to see a rapid reversal. And we saw that in March. With the banking crisis, the quantitative tightening came to an abrupt halt, and in 15 days, the Fed's assets went up to the level of last November.
So your message is listen to the bond market, not what Fed officials are saying at this point, basically?
Exactly. Listen to the bond market, and also one more, don't listen to the equity market. Look at October of 2007, the equity market, the S&P 500 hit a peak, record level. But the bond market was suggesting a recession, and in the case of the economy, the bond market is a better predictor than the equity market has been.
So what that individual means when he says pay attention to the bond market, basically the bond market is correct over the stock market. That is true. There's very large individuals that buy bonds, governments buy U.S. treasuries. Now, the bond market is anywhere from 3 to 5 times larger than the stock market, depending on the year. If stocks are doing well like 2021, then obviously the bond market's not 5 times larger than the stock market. During that time, it was only about 2 times larger than the stock market. Now, it's about 3.5 times the value of the market. So you definitely want to pay attention to the bond market. The bond market tends to be right more than the markets. Now, specifically what's happening in the bond market now is you have seen the yield curve inversion. It's been inverted. This is the chart of the 10-year and 3-month yield curve inversion going back to 1982. I believe this is as far back as we can go. Yeah, I tried to type in 1952, and this is all you have. So what you see is during the inversion periods, if you were to track this on the market basis, markets don't actually sell off when this goes inverted. And when the 10 and 3 month inverts, you're pretty close to a recession regardless. Well, that has been largely delayed as we are not in a recession right now. But when stocks actually take the beating, it's actually when this chart starts to go higher. That is, at the moment in time, you are right about to see a recession. And usually when this starts to kind of go higher, it usually goes pretty quickly. It's not a slow process like inverting sometimes can be. As you can see, we have started to uninvert. I'll scroll down so you guys can see this indefinitely. Well, once you start to invert, it goes pretty quick, and then you shortly thereafter head into a recession, as you can see from the kind of darkened points on this chart. Same is true with the 2 and the 10-year yield curve inversion. Same story. You don't tend to see pain in the markets when you're actually inverting. It's once you start to uninvert is when you're close to a recession, sometimes within a month or 2 months. But always within the next 6 months, you head into a recession. And that's where you can see these periods of darkened points here on this chart. You've started to uninvert quite a bit, so pain could be coming. As you can see from these two charts, every single time the yield curve has went under this black line, especially your 10 and 3-year yield curve inversion, you have always seen a recession. Think about it to yourself like this. Why would you get paid more investing your money for 3 months rather than 10 years? That's telling you something is wrong. You ripped it? This is what she showed me. She ripped her Mickey Mouse, and then she ripped the head. Ugh, now it's stuck together. As you can see, we're struggling over here. This single solo dad thing is definitely quite a bit challenging. And she ripped She ripped the duck off her bed too.
No, they did.
The dog did. My apologies. But that is obviously neither here or there. Take a look at this from the AI sentiment. Now, the current sentiment for the markets as of September 13th is 34.4% bullish, 36.4% neutral, and 29.2% bearish. What I find interesting is that individuals were actually more bearish for the first week of September, at 29.6% of individuals bearish for the first week of September. The amount of bullish investors, though, has fallen quite a bit from last week. Last week, 42.2% of investors were bullish. This week, 34.4% of investors are bullish. But what you have seen jump dramatically is actually the neutral rating. So 28.2% of investors were neutral in the first week of September. Now, 36.4% of investors are neutral. Now, if you think about this as a progressive kind of thing, what you would expect to see happen is the amount of investors, if things were to kind of go downhill, the amount of investors that were bullish would obviously come down. The amount of investors that were neutral would go up. And then eventually that neutrality could translate into more bearishness. Now, the 1 year bearish high was 60.9%. Even as of August 23rd, you were 35.9% bearish. Today, you're 29.2% bearish. So what I'm trying to get at here, what I'm really trying to highlight is you've seen more people go from bullish to neutral if selling does continue and, stocks continue to perform not great in the month of September. We all know the seasonality of September does not tend to do well after quad witching. Well, more people could become bearish. And really why I'm trying to highlight this now is if you don't have hedges on your portfolio, if you are not protected, if you're not playing any downside, it's not too late. There's still a big gap here on the 1 year bearish high and where we are today, meaning that stocks could fall quite a bit from here if there is a reason for that to actually happen. And the two things that would actually cause that, in my opinion, it all boils down to one thing. And that would be the economy doing poorly. If inflation revamps, I don't think that is going to happen. I don't think that's a reason for stocks to sell off. We just seen the inflation report last week. Month over month headline came in hot. Core came in hot. Year over year numbers came in hot. Nothing was good about last week's inflation report, and that did not cause a sell-off. The Fed could be something that could cause a sell-off. That is obviously true. But I think the one thing, if the Fed were to cause a sell-off, it's not because they raise rates one more time or two more times. It's because the Fed signals the economy is slowing down. And we could see that at the summary of economic projections, as I highlighted here. We're not going to get into that here in this video because we've already talked about that today. But essentially, you want to be watching the change in GDP if estimates continue to go down, as we have seen throughout all of 2023, the estimates for 2024, that is, as well as the Fed funds rate projection. If the Fed all of a sudden starts to expect lower interest rates in 2024 and 2025, that only happens because the economy goes downhill. Given the UAW strikes, given the student loan repayments start in October, some of the data we have went over here in this video and heard from other investors and analysts and billionaires essentially, well, there's a strong case to be had. There's not that much upside left in the markets, that the downside is coming. Just the question is when. Now, something else that I also think is pretty fascinating that should be sending off alarm bells for everyone is this yellow line right here. This is the Russell 2000. And let me just take that off so I can kind of move this chart around now. You are far off of your highs. Far off of your highs. Let's see. From the high of the Russell, that is the IWM, small cap stocks, you are down still 23.22% from the high. On the S&P, nowhere even close to that. On the S&P, you're only down, it says about 5% from the highs, which I mean, IWM, the Russell, is down, what, 4 times more on a relative basis than the S&P. Now, why this stands out to me is if we're going to have a great economy and maybe even higher inflation than what we're used to, your Russell should be the main beneficiary. Your Russell should be what everyone is looking to buy. In fact, it's the opposite. Russell stocks sold off big time today. That is very much a risk-off kind of environment. If you were theoretically to go through a down period in the markets and get weakness, you would see the Russell sell off first. You would see kind of stocks that are related to the economy sell off, your cyclical stocks, and then you would see your technology stocks. Those would be really the last ones to get hit. Obviously, in 2022, it was quite the opposite, right? Your tech kind of went down first. Your small caps went down first. Your tech went down next, and then your kind of value stocks came down after that once tech started to catch a bid and actually perform okay. So this is not great. And what you've actually seen recently is the IWM has fallen, let's see, just recently, has fallen about 8% from the levels that we were just at. The S&P, on the other hand, has only fallen about 3%. So IWM is massively underperforming the S&P even as of recently. This is not great. Now, I would like to reiterate again that I am nowhere close to bearish on Tesla stock for 2024, but from now until the end of the year, I'm kind of bearish, pessimistic on the markets. I just think the markets are too high given the uncertainties out there. I think there's a lot greater chance, a 95% plus chance, markets fall 5 to 10% from here rather than rally 5 to 10% from here and get back to all-time highs. And if markets are to get to all-time highs, if you are in the ultra bullish camp, 2 or 3 things need to happen. Number 1, we need validation that earnings are going to start growing. A lot of your big tech names are negative on a year-over-year earnings basis. That's not going to support almost record high valuations. Sorry to say it, you need earnings validation. That could come in October once we start to get earnings, and ultimately in November when you get some of your other companies like an Apple that reports earnings on, I believe it's November 17th, maybe in November 11th or 4th or something like that. Don't quote me on that. So that's number 1 you need to see happen. Number 2, you need to see the recession that a lot of people are forecasting just never comes. It would be the first time in history some of these indicators like the yield curve being inverted, well, that's always led to a recession. So you basically have to be betting that the outlier to that 50, 70 plus years of data would be this year. So if you're willing to make those 2 bets, well, that's a step towards all-time highs. The third thing you need to see happen is inflation continue to come down. If this inflation spike continues, well, unfortunately, you're not going to see all-time highs. Inflation makes company earnings worth even less. So on top of earnings not growing recently for big tech names, well, you've also seen high inflation. So really on a net, you're massively negative on earnings, yet valuations are at almost all-time highs. These things are not great. And I guess you'd call it maybe the fourth thing is the Fed lowering rates. Now, the way I see this is if earnings are good, inflation comes down, and this recession never happens, well, you can see higher interest rates and still get past all-time highs. Still make your way, to 500 on the S&P. That doesn't matter. The markets can get over higher interest rates. If earnings outcompensate for that, then that's fine. But if that does not happen and inflation does go down and we avoid a recession and the Fed does start to lower rates, well, that's I guess your second best alternative to get the markets to all-time highs. But without those things happening and multiples of those things happening, 2 or 3 or all of them happening, it's not going to happen. Markets are not going 5 to 10% higher from here. The only trajectory would be to the downside. Let me know how you guys feel about this market down below in the comment section. Are you bullish? Are you bearish? Really throughout the rest of this year. I feel like a lot of people are pretty bullish on 2024 as far as Tesla. How could you not be when the estimates are 27% delivery growth, 29% EPS growth? You have to be insane to expect Tesla to experience its worst year of growth since going public back in 2010, in the year in which the Cybertruck hits the mass market. You gotta be I mean, I almost said something that is not YouTube appropriate that would probably get me shadow banned. That's to the degree of which the insanity would have to be negative on Tesla in 2024. I think that is very unwise. But over the next couple of weeks, next couple of months, there's a good argument, like I said. So, regardless of who likes it or who doesn't, I will bring you this information you need to know to hopefully protect yourself on the downside, hedge out your portfolios if that is something you so choose, or at the very least be ready to buy the dip if that dip does ultimately come. So if you guys want to come hedge with us live in real time, come trade with us, link down below in the description of this video. I mean, just support the channel. That's always an option as well. Link down there for that one. You guys enjoy the rest of your day and your night. My name is Michael Tyler, and I will see you in the next one.